Hey everyone! Welcome back to Your Money Your Way. Are you on the hunt for potentially steady income in what feels like a constantly shaking market? Maybe something that could offer a decent yield while tapping into a pretty resilient sector? Well, today we're diving deep into a company that plays in the Asia-Pacific industrial and logistics space. Think warehouses, business parks, the engine rooms of modern commerce. This particular player recently reported its full-year numbers and is currently offering a forward dividend yield that might just catch your eye. We're talking around the 7.4% mark. But is it all smooth sailing, or are there hidden currents investors need to watch out for? Let's get into it. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Alright, the company we're putting under the microscope today is AIM's APAC REIT, or AA REIT for short. They trade on the Singapore Exchange under the ticker O5RU. AA REIT owns and manages a portfolio of 28 industrial properties, 25 in Singapore and 3 over in Australia, valued at around 2.13 billion Singapore dollars. They just wrapped up their financial year 2025, which ended on March 31st, and the results have given us plenty to talk about. So, what's looking good for AA REIT right now? First up, their financial performance in FY 2025 was pretty solid. They grew their distribution per unit, that's the payout to unit holders, by 2.6% year-on-year, hitting 9.6 Singapore cents. Gross revenue was up 5.3% and net property income climbed 2.1%. A big driver for this was strong rental reversions, which came in at a very healthy positive 20% for the year. That means when old leases ended, they managed to sign new ones at significantly higher rents. Next, they've been making some smart money moves with their capital management. Their gearing, which is like a measure of debt, is down to a pretty low 28.9%. This gives them a lot of financial flexibility. Plus, they don't have any major debt refinancing needs until their 2027 financial year, which is great for stability. One really clever move was issuing new 5-year perpetual securities at a rate of 4.7%. They're using this to pay off older, more expensive ones that were costing them 5.65%. That's expected to save them about 1.2 million Singapore dollars in interest payments annually. And to top it off, about 85% of their debt is on fixed rates, shielding them from a lot of the recent interest rate volatility. And it's not just about managing money, they're also actively building for the future with their portfolio strategy. They've got 2 major asset enhancement initiatives underway in Singapore, one at 7 Clementi Loop and another at 15 Tai Seng Drive. These are basically upgrades to existing properties. The great news is they've already secured long-term tenants for these before the work is even finished, and they're expecting these projects to generate an NPI yield of over 7% once completed. That's a very attractive return. They also sold a non-core property, 3 Toh Tuck Link, for a price that was 32.5% above its valuation, a nice bit of capital recycling. And it's worth noting that a big chunk of their income, over 83%, comes from tenants in defensive and resilient industries, which is a good thing in uncertain economic times. Okay, it can't all be sunshine and rainbows. What are some of the potential headwinds and risks for AA REIT? Well, that strong rental reversion growth I mentioned. Analysts and management expect that to slow down a bit. It's hard to keep up such high growth rates indefinitely. We also saw their tenant retention rate dip in FY 25 to about 64.8%, down from over 79% the year before. Portfolio occupancy also fell slightly to 93.6%, although if you exclude the properties undergoing those upgrades and some temporary tenant movements, the committed occupancy is a healthier 95.8%. Then there are a few nuances on the balance sheet. Their net asset value, or NAV per unit, actually declined from 1 Singapore dollar and 31 cents to 1 Singapore dollar and 23 cents. This was mainly due to their Australian assets facing some valuation pressure from rising cap rates and a weaker Aussie dollar. Their interest coverage ratio is stable at 2.4 times. Now, this is above the regulatory minimum, but some analysts see it as a bit borderline, preferring something closer to 2.5 times or higher for a healthier buffer. And while their official gearing is low, if you include their perpetual securities, which are a bit like debt, their all-in leverage is quite a bit higher, around 52% according to one analyst. That gives a slightly different risk picture. Finally, there are broader market and tenant-specific risks. The global macroeconomic outlook is a bit murky, with forecasts for slower GDP growth and uncertainty around global trade policies. This could, of course, impact tenant demand. And speaking of tenants, AA REIT does have some tenant concentration. Their top 10 tenants contribute over 50% of their gross rental income. If one of those major tenants had issues, it could have a noticeable impact. So, what's the city saying? Analyst sentiment is generally positive. Most have buy or equivalent ratings on AA REIT. They like the proactive management team, the successful refinancing of those perpetual securities, and the strong operational results. However, they are also cautious about how long those high rental reversions can last and the potential impact of those macroeconomic uncertainties we just talked about. The consensus price target from analysts is hovering around $1.47. All right, the million-dollar question, or perhaps the 9.6 cents per unit question. Is AA REIT a good bet for long-term investors? Let's recap. On the plus side, they've shown resilient DPU growth, significantly de-risked their balance sheet with smart capital management, have a visible growth pipeline from those AEIs which are already largely pre-leased, and their portfolio is weighted towards defensive sectors. Management strategy seems sound and they've been executing it well. And that forward dividend yield of around 7.4% is certainly attractive in the current environment. On the downside, growth from rental reversions is likely to moderate. There are those macroeconomic headwinds. The interest coverage ratio is something to keep an eye on, the effective leverage when you include perps is higher, and there's that tenant concentration. Future growth will heavily rely on the successful completion and income generation from those big AEI projects. From a valuation standpoint, it's trading at a price-to-book ratio of about 1.03 times based on its recent share price and NAV. Ultimately, AA REIT offers a relatively stable profile in the industrial REIT space. It's about balancing that proactive management and near-term growth from upgrades against the risks of a slowing market and those specific financial characteristics. So, there you have it, a deep dive into AIM's APAC REIT. It's a company with clear strengths and a proactive approach, but also faces the realities of a complex economic environment. Now, before we wrap up, the usual important reminder. I am not a financial advisor, and this video is purely for informational and educational purposes. It is not financial advice. Investing involves risks, and you should always do your own thorough research and consider consulting with a qualified financial professional before making any investment decisions. All right, now I want to hear from you. What are your thoughts on AIM's APAC REIT? Do the potential positives outweigh the negatives for you? Are you invested? Or is this one you're watching from the sidelines? Let me know your opinions in the comments section below. And if you found this video helpful, please give it a thumbs up. It really helps the channel, and make sure you're subscribed and hit that notification bell so you don't miss out on our next deep dive. Thanks for watching, and I'll see you in the next video.